Everyone, welcome to JEDi episode 3. My name is Jimmy, and with me today are Ethan and David. For those of you who tune in to our Facebook Live for the first time and you want to know more about us and the name JEDi, do check out our first episode in the video section. I'll be the moderator for this episode, so here's how we're going to run through. Firstly, we'll address questions that were raised from the previous episode on expense tracking. And then Ethan and David will have a fireside chat on asset allocation. Then we move on to the bonus section on how to earn cashback from paying income tax and paying insurance premium. Then last but not least, we'll have a Q&A section for the current episode. So feel free to post your questions in the comment section and we will address them during the Q&A section. Right. So now let's move on to the questions that were raised during the previous episode. I'll let Ethan begin. Right, Ethan?
Yeah, sure. Okay. So we had a Q&A from the last episode which we have not followed up yet. So the question is, do you value cashback more than miles? So maybe Jimmy would like to start first.
Well, personally, I value cashback more because I'm someone who seldom travel. At most, I travel overseas at most once a year. So I personally feel that earning miles for at most once a year is doesn't really justify the savings that I will earn. So instead, I'll go with the cashback way. Cashback allows me to earn cashback from multiple eligible spend. Yeah, so that's where I get the most out of the savings. Right. What about David?
Sure. For me, right now at my current stage, I'm looking at cashback because for me, getting cashback means that I can get returns on this cashback. Even if I go for miles, then I'm pretty sure it stays as miles. I won't earn miles on top of the miles. So to me, I would prefer cashback right now.
Okay. Ethan, you have anything to add?
Okay. For me, I always aim for 8% cashback or miles if possible, because that seems to be like a very good cashback amount. If 8% at cashback, it's better to get cashback. If it's less than 8%, maybe you may want to look for miles, because when you do the exchange rate, let's say if you are doing like for travel, economy class, 8% seems to be the middle ground. If you are going for business class, then the miles will be like 10%, 12%. So it really depends on whether you want to travel or not. If you don't want, then cashback will be better in this case. Of course, you may think of selling your miles, but I think that's a further thing already. Yeah, so that's for my opinion.
Okay, cool.
Okay. So let's go for the second question. Are there any other hacks, as Singtel Dash is going to remove the topping out of Singtel bill after May?
David?
Okay. The funny thing about this is that Singtel Dash, right, they keep on saying that they're going to remove it from their Singtel bill, but I don't know whether they will really go through it this time. But as always, we don't stick with one hack. We don't stick with one cashback option. So Singtel Dash is just one way. There are so many other ways. Like for example, recently, MCO card, you get 10% off your you can just move it to GrabPay, MasterCard, and then from there you can use it for anything. So for now, that's the best path.
Okay. For me, If you want to know more hacks, just subscribe to us lah. Then you will know already, ma, tio bo. I mean, okay. To be very serious, all these hacks, if you share too much, sooner or later it will be removed or it will be patched up. The loophole will be patched up. So we try not to share too much at one time until like we know that okay, it's going to be removed very soon. Then we can go public. But for the rest, I think it's better that we keep it to our internal group, if you understand. Yeah. So definitely we will share more, definitely. Okay, but I think that's all we can share. Yeah, let's move on. Let's move on. Okay, so today we are going to talk about asset allocation, and these are the table of contents. So, okay, why do we allocate and track our assets? So you can look from the three sub-circles, risk, liquidity, return. So it's more about understanding your own portfolio, how much risk, how much liquidity you have, and what are the projected returns that your portfolio should give you. Then the other way is also to like the magnifying glass to identify your risk factors inside your portfolio. So it can be that you are too overweight into properties, you are too overweight even into CPF. Yeah, that can be a very big risk also. Or you are too overweight into equities in the US or in China. So it's best that you understand your portfolio characteristics. So when economic change, right, or when COVID hit us, or when US had this trade war, it's going to affect US and China. So at least you know how much your portfolio will be affected when things happen. Okay, so there are actually a lot of myths on asset allocation. So we got people telling us, hey, I got a 60 equity, 40% bond portfolio. My returns are always fixed one, no worries one. But in investment, where got fixed? Or my assets are fixed. So let's say you are paying for property, you're always paying to your property. So your percentage of your property should be increasing. It is not fixed. So there is always timing required to rebalance all this. And I always have people telling me, oh, this is the best portfolio. But don't think like the Pegasus, it may instead become a donkey. Right? So really you have to understand your asset. We're not saying that we are best at asset allocation, but we're just saying that you really need to identify what is your asset allocation. Okay. So you really need to do yearly reviews on your assets and balance if required. So let's say for now, equities have risen back to the normal levels. So if you have done your balance during March, then you would have take profit from your bonds and put some into equities already at that point of time. Then by coming here, now it's already like May, June, your equities have returned back to the previous level. Then your equity should be at a much higher ratio than your bonds really. So you also need to understand that your returns are projected and it is only realized when you either sell or when you take a snapshot of it. You definitely need to adjust your plans. And if really you cannot manage your own investment, I always advise to outsource if it really makes sense to you. So what are liquid assets to us? Okay, liquid is something that is able to provide flow, in this case, cash flow. So assets that are things that you can convert to cash. So liquid assets to us are actually like cash, bonds that you can sell immediately, or things that you can sell to get money in a very short time within 1 month. Then what are long-term assets? Long-term assets are things that take time to really get money. For example, your property. You say you want to sell a property, the next day you sell, you get the money already, man. No, it takes at least 2 months for HDB to cover the whole property sale. For CPF, even worse. At age 55, then you think, okay, maybe I can get. Endowments wise, because they have maturity in part, so a certain amount will be locked in. For those that is anticipated endowments, i.e. those that have cashback, those are more liquid. So I'll take that as liquid asset. But those that is locked into the surrender value, they are not liquid. Retirement plans also, because if you anything to do with insurance, you surrender early, you take a loss already. So that is why it's considered a long-term asset where it appreciates at a normal phase. Okay, so we are moving on to our asset allocation. So we are starting our fire check now. Okay, this is our overall asset allocation. On the left, you can see David has a lot of things, DBS multiplier, P2P lending. He will actually elaborate later. And for me, I just have a few. So maybe on to you. Yeah, you can actually let us know what's your asset allocation now.
All right, sure, thanks. So for me, you see that most of my asset is allocated into property. So I have two private properties, and they make up 55% of my current asset allocation. They are generating about 8% yield, uh, and it is pretty good because it's an investment property. So the amount of rent that I collect is higher than the usual. My next major asset allocation would be in my CPF. So that would be 20%. And all my CPF funds are currently in OA and in SA and MA. I don't have any in my OA. I shift it out as soon as I can because of the interest rates. So the blended returns are about 4%, 4 point something. So these two are my long-term assets in housing and CPF. As for my liquid assets, they make up 25%, of which 13% in DBS multiplier would be the major chunk of the pie. So I am able to reach the highest tier. So I get about 3.5 to 3.8% from this. As for the rest of the funds, they are all in like other savings, fixed deposits, foreign currency fixed deposits. I also do some P2P lending. So I lend to businesses that I have a stake in, and the interest that I get is about 15% blended. I also have some endowment. This is a legacy endowment which was purchased a long time ago, and I'm getting about 8% per annum on this. So I plan to hold it for another 5 years. And I also own some crypto. One of my businesses is in the crypto space. So I get about 10% per annum returns on these crypto assets.
Okay. David, I think there's one question that is very interesting to you. So there's one viewer that says, do you count assets as net or gross? For example, property value minus loans. So you may want to address this first. I think that's why they want to see how you get 8%.
Oh yeah, sure. So 8%, right, is based on the valuation price. Actually, no, sorry. Yeah, 8% is based on the valuation price. So sometimes it goes lower. Sometimes it goes higher. Depends on valuation. So recently, actually, if you notice, prices have come down a bit, but they are still above my buy price. So right now it's 8%. I'm not looking at value price minus my loan price, then I get 8%. No, because if I look at value minus my loan price, that will be my cash. Then you're looking at cash on cash returns. The numbers will be maybe 24 to 30%. Then it will not be 8%. Yeah.
Okay, thank you, David, for your explanation. Yeah, so maybe let's move on to mine. Okay, you can see mine is split equally between house and CPF. Okay, for me, my house is different from David's. Mine is a self-owned property. So I'm actually looking at a 3% annual increase of the asset value, total asset value, which is total asset minus the loans. And that is where I get my 40% out of it inside, invested into my own house. For the CPF, there's another 40%. So because I have been working for very long, and a lot of my cash has been used to service my parents, my other housing needs, and for my wife's one, her salary is just pure savings. So that's why there is a very big gap between mine and hers. Okay, so for me, I do have a few endowments that I took over as a traded endowments, and I'm looking at about 4.75% returns, but it can be up to 20% depending on how I manage it. I also have an OCB 360 account, which is my main savings account, and I do some P2P lending at 10%. Yeah, so that's how I got my blended return at 3.87% per year. So just to be clear, yeah, I need to understand that, yeah, I'm heavily invested in house and CPF, so I'm trying to reduce it as much as possible for my case. Okay, so now David has a lot of experience in doing investment property, so he's willing to share this. Yeah, so on to David.
Okay, so I track my property performance quite carefully because they are investment properties, and I want to make sure that I make decisions based on the numbers that I see. So I look at two major factors. One is capitalization rate. So capitalization rate is the amount of um, uh, returns, the yield divided the net operating income divided by the total valuation. So let's say, for example, if you are getting $60,000 per annum profits, and you divide it by the valuation of 1 million, that would be 6%. So if it if let's say, for example, your valuation goes up to 2 million and your net operating income is still $60,000 per annum, that means that your capitalization rate has dropped to 3%, and that is not good. So you should be selling your property if the valuation has gone up and your your net operating income for your rent remains the same. So net operating income is the total revenue minus the total expenses. So if your capitalization rate is maintains at a high rate, then I would say you can keep your property. If your capitalization rate decreases, and if that is because your valuation went up, then good for you. You should sell because there are better opportunities out there. If your capitalization rate has gone up, then and if that is because you have increased your operating income, then good, you have done something to increase your value. But if the reason that your capitalization rate has gone up is because of your property value going down, then that's a problem. You might want to consider selling it in case it drops even further. But if you think that you can maintain your capitalization rate or keep it high, then why not? It's a asset generating, it's an income generating asset for you. The next major factor that I look at is a loan to valuation ratio. So if your loan is low and your value is high, that's a good thing because you are safe from any margin calls or any economic downturn. So the idea is to keep it low, but not too low, because if it's too low, it means that you have a lot of money stuck. You're not using your credit properly. So if your valuation is increased, then that means so let's say, for example, your valuation has gone up from 1 million to 2 million, and your loan remains at, say, 500,000. So initially, your loan to valuation ratio is 50%, which is very safe. But when the valuation has gone up and your loan to valuation is at 25%, that means maybe you should explore some equity cash out options to take an equity loan from your property. Of course, this only applies to private properties, so you have to be aware where you stand in terms of your loan to valuation, so that you can make the right decisions. So if
So
you
it's
notice
actually,
for my properties, they are both at about 50 to 60% right now for loan to valuation. I think that is quite safe. The current MAS regulations is 75% when you buy a property or when you want to do refinancing.
okay, so am I right to say that the amount of money that is stuck inside is actually very important because there is an opportunity cost to it, right?
Yeah, of course, you want to make sure that your money is working properly for you. You uh, have to use your money wisely. Yeah.
Okay, thank you, David, for sharing his experience in investment property. So let's take a look at our net worth and asset allocation. Okay, we are actually tracking this month by month in February, March, April, and the percentages. Like what I mentioned earlier, our percentage in property, CPF, and other liquid assets will change every month because of this. Yeah, so David, can you share yours first?
All right, sure. So I track my net worth change. So what you see here is a percentage graph. Um, there's actually not much change in my net worth on a month-to-month basis, but I still track it to I track it over the years lah. So this is just over the last 3 months. You see about 6% increase in March, 3% increase in April. So to me, it's just have to be mindful of what is the what's the size of my basket over time. Yeah. Uh, the three other bars would be my percentage in liquid, percentage in property, and also percentage in CPF. So this would be my short-term liquid assets and also my long-term fixed assets. So generally, I try to be to have more allocation to properties and CPF during boom times, and also when we are moving towards a bear market. So now, over the past 10 years, actually, in the past 5 years, I've been pushing a lot of money into properties. Uh, this might change if we see a major financial crisis. I might move more into liquids rather than keeping it in property. Um, as to my CPF, I try to keep it under 20%. This means that for every $1,000 in my CPF added, I need to add another $4,000 in either cash or property, which can be quite tough lah. But I'm trying. Yeah.
Okay, thank you, David, for sharing. Yeah, so let's move on to mine. For me, my net worth change, there's also not much changes, but you can see that there is actually a spike from property in March to April. So which means that I've been paying down my property a lot. CPF is constantly increasing, but less liquid assets. So this is something that I think is of worry to me. So I actually aiming to be like David already, to have more liquid and other forms instead of just a property, CPF, and yeah. So that's for mine. Okay, so we have moved on to the bonus session whereby how to get cash back for your income tax. So please follow the link at Facebook Live, like and share, and subscribe to our YouTube channel also. So you can also look at the links inside PolicyWoke.com/links where it shows all the referral codes and sign up process for some of the accounts that we have. So, David, how do we get 8% cashback on income tax?
Yeah, so okay, last time when we have the UOB1 card, then we keep on moving money to GrabPay Mastercard, and then we get 10% cashback, right? So
Yes, correct.
if you have been doing that, then you have quite a sum of money in your GrabPay Mastercard. So recently, there's this 10% of for MCO card. So this MCO card, the sign up link is on our Facebook, on the links page. So recently, if you haven't done it yet, you can consider doing it for this month. And I think next month I think might be the last month. I don't know if they'll extend it, but who knows, So if you do that, then you move money from your MCO card to your GrabPay Mastercard, and then you can use GrabPay Mastercard to pay your income tax through this portal called CardUp. So when you pay through CardUp, there's a fee. I think right now the promo rate is 1.78 or 1.88%, around there. So if you take 10% minus 1.88, then you have about 8% cashback on your income tax. Of course, this applies to only whatever amount is in your GrabPay Mastercard. So if your income tax bill is $500, then great, you can get 8%. If your income tax bill is more than that, then maybe you have to calculate, see how much the cashback is, whether it's better to do this or to use other cards. Yeah.
Okay, so thank you, David. So there's also another way which most people have been doing, which is using their UOB1 card, pay through card to their insurance premium or to income tax. So for UOB1, there's a minimum spend of $500 where you get 3.33% tax cashback, and from that cashback, minus away the 2%, you get about 1.3%. I think it's not too shabby also, but if you are spending 2,000 or more, there are 2,000 cap, should be 2,000 cap, you get 5%, and the blended amount will be 3% instead. So let's say if I don't have any other cards that I can actually get cashback. So what do you suggest for the rest who really, I don't have this GrabPay Mastercard, MCO card, whatever card?
There's this card called HSBC Advance. So HSBC Advance allows you to pay for this card up. So you get 3.5% if you have the advance account and you spend minimum $2,000. So let's say if your bill is more than $2,000 and you have already exhausted your other cashback cards, you can consider this HSBC Advance card. There's also another card called Manhattan card from Standard Chartered. So they give 3% cashback. So if your bill is up to $6,600, you can use this card.
Okay, thank you, David. I think there's another way which I found out. Okay, for income tax, right, you can actually pay through gyro, right, over a period of 12 months. So let's say interest free. So let's say if you have 10,000 already, you can put into this Singlife account where you get 2.5% per annum, but it's calculated on a daily basis. So on the time where it's required to gyro that amount, right, just deduct it from the Singlife account or from your bank account, and you can shift funds from Singlife account to your bank account through that way, and you can at least earn about 1.25% blended return. So it's not too shabby. At least there's still some returns for the interest free from that. So that's a way for those really who have like tens or 20 or 30 thousands of income tax to pay. Okay, so we have come nearing to the end. Yeah, so Jimmy?
Okay, so thank you, Ethan and David, for the fireside chat. We hope you find it valuable for your own asset allocation and the cashback hack they mentioned previously. We will now go for the Q&A session. So if you have any questions, feel free to post them on the comment section as we are addressing them. So currently we have two questions. First question is for David. He asked if you are employed or self-employed, David.
Both. I have a few businesses. So one of my businesses, I'm an employee director. In other businesses, I'm the director, non-employee. So I'm self-employed in those companies, and for just one company, I'm a salaried uh, employee.
Okay, cool. So next question. Not sure if it's for Ethan or David. The reason why, he asked for the reason why you substitute your portfolio of OA into SA or MA. Not sure if you get the
Oh,
question.
yeah. Just now I mentioned about my CPF funds in my SA and MA because for me, my aim is to reach the full retirement sum, which is the FRS. I am not aiming for the ERS, which is the enhanced.
Okay.
I'm aiming for FRS because that would allow me to get living expenses from this CPF life in the future. I think it's good enough to sustain one person. So that would be the minimum amount that I'm looking at. I'm for me, I do CPF top ups to my SA account for the purpose of not just tax savings, but also because, like I said earlier, I'm not a full time salaried employee. So my blended contribution to CPF is about 15%. I provide 20% from my salary business, and I also provide about 6% to 7% for my self-employed contribution. So to me, I think if I'm trying to hit FRS, I did some calculations. I need to put in 7,000 every year for the next 5 years before I can let it accumulate by itself to reach FRS. So to me, all my funds are in either SA or MA. For OA, I don't use it for any purpose. I don't use it for investments. So that's why I move it over. I also don't use it for property because I rather use cash for property.
Okay.
It's very helpful when you have full cash in your property if you are thinking about doing um, cash out equity loans in the future. Yeah.
Right. Okay. Is there any more questions? Okay, I think I have one question. Um, just curious. Do you have do you do you yourself, because if you have so many assets in your allocations to manage, do you engage your own portfolio planner or financial planner to keep your allocation in check, or do you manage the whole allocation by yourself? Yeah, so maybe David, you want to share?
Hmm. I think the thing about all this information is uh, for some people it might be sensitive, like, oh, I don't want anyone to know how much I have. Um, but
Mhm.
the truth is, the more you share, right, the more um, accountability you have, and maybe the more responsibility you have for your personal finance.
Mm-hmm.
For example, right now I'm helping a friend with his personal finance to see what is his allocation and also to see what is the next step forward. Because without all these numbers, you don't really know what is the objective way to move in the next 3 months. For example, like for myself, right now I know that my my property is 55% of my portfolio.
Yeah.
So when I look to the next 3 months, I'm thinking maybe there might be a shift in the economy. Maybe there might be a shift in the markets. In the past financial crisis, prices of equities dropped about 40% overall. So some stocks they go down much more than that. So the question is it better to stay in property when that happens, or is it better to shift some assets into equity in the next two years? So that's something that I'm considering once I know how my portfolio is like.
Okay. Okay. Right. So, okay, for the viewers out there, do you have any more questions? If not, then we'll go on to the end of this episode. Thank you for tuning in and all the questions you have for us. But don't worry, if you still have questions with regards to asset allocations and the cashback that you can get from paying income tax and insurance premium, you can still post your questions in the comment section and we will address them during the next episode. Speaking of the next episode, join us next Friday, 5 p.m. for JEDi episode 4 on maximize savings. If you like our content and be notified for future episodes, do like our page and share this post. We will see you next Friday, and may
May
the
May the finances be
finances
with
be with
you.
you.
goodbye.